Joining us now is Rebecca Walser. She is president of Walser Wealth Management, and she joins us from our studios here in New York. So it seems like when you look at the U.S. equity market price action, the Trump trade has lost a little bit of steam.
Yeah.
Does that come as a surprise?
Well, I think it's really induced by Powell and his comments. He really is feeling sort of put into a corner now because they announced previously, obviously, we were expecting to have 6 rate cuts and from all the hikes. And we then saw inflation. So he was kind of hamstrung and couldn't do that. And now he's started. So the market kind of is expecting to see another 25 basis points in December next month at the FOMC. But his comments this past week basically said, whoa, we are going to look at the data. And I think, Doug, it's because if you look at the last 25 basis point cut, we're right back, the 10 years right back to where it was prior to that cut. So what you're seeing is the market and the risk of the market pricing in higher yield, even as the Fed cuts.
Well, that's an important point. Do you think that a lot of what you're hearing coming out of the president-elect and the new administration, the policies that are being articulated seem to be a little inflationary, and maybe that's what's causing the Fed a little concern here. Is that a fair statement?
Yeah, I think that what we're seeing really is a strengthening dollar on a weakening world, and that is making everything, the yields come up higher. You know, the dollar going up hyperbolically compared to the global world is a problem for us because that's going to make our, everything too expensive for us, and that is an issue. I think Powell is realizing that we have a $1 trillion deficit every 100 days, and that is creating the Treasury Department having to just, consistently fund more than what we're used to. Yellen has been doing everything on the 2-year as opposed to what's more normal on the longer term, 10 and 20. And so she's doing that intentionally, Doug, to keep the longer term yields down. So now you can see both the Fed and the Treasury both in concert working to make sure that long-term yields stay lower. And that tells me that they are pushing up against a tsunami of risk that is getting priced automatically into this bond market.
So you mentioned the stronger dollar there, right, as the consequence of higher yields. But the flip side of a strong dollar is weaker oil prices. What do you understand to be happening in the oil market right now?
Well, that's where I'm really alarmed because two different traders and commodity brokers that I really respect and have a long-term track record are saying so much weakness is coming in the global demand for crude that if we break through a 64 threshold level, we're probably going to get to a 50 to 55 price per barrel, which would be, for, I think of Saudi Arabia and MBS, and I know he's going to fall out of his bed on his head. I mean, he can't afford to run his, empire on that level of oil. And that's with OPEC still cutting. That's with OPEC still not having, additional supply. So constrained supply and still weak demand. We're looking at Germany. We're looking at China. And between those two in the Asian theater and the European theater, we can just see global sort of pullback recessionary trends coming.
So if these forecasts are right and we see a big pullback in the price of oil, that removes the incentive for these companies to try to drill for more, right?
I mean, that is a problem. I do think that we are going to have an administration who is more domestic production producing. And we've already seen Europe post-election say, all right, we might be interested in buying gas or, crude from America instead of Russia. Although that's been changing. So that's a problem, Doug. Like we would see in Trump someone who could domestically create that engine of growth again, unless the world doesn't want to buy our oil because no one's buying.
So where do you see the global economy headed right now? You mentioned weakness in Europe. You mentioned weakness in China. I mean, are things across the world right now downshifting into a much slower rate of growth?
Absolutely. Without a doubt, without a question. And I think it's been so obfuscated for us here because we've been so we had a crazy election cycle. I mean, nothing like that has happened in decades. So we really had some craziness happening. And I think that a lot of people were concerned who was going to get in and how was the market going to handle that person. I wasn't a fan of some of Kamala's unrealized tax gains plans. That would not have been good for investors, Doug. So I think from that perspective, from a taxation perspective, investors are a little bit better off under Trump's tax policies. But the fact is if we get this global slowdown that we're starting to see materialize, to the United States, which of course it comes to us last since we're the reserve world currency, we will not be able to really get ourselves out of this. And that really sends me to like Elon Musk and Vivek Ramaswamy with their DOGE, Department of Government Efficiency. We're spending over $6 trillion right now. And Elon Musk is saying he wants to cut $2 trillion from the budget. Now, I think that's great because we can't sustain all of these things indefinitely into perpetuity. However, how much of that $2 trillion is contributable to waste, fraud, and abuse? Because if it's not waste, fraud, and abuse that we're cutting, then we're cutting real benefits to real Americans that really deserve them. And that is a really big issue that we're going to have to figure that out.
Let's talk about another part of the Trump economic plan, which is tariffs, especially where Chinese goods are concerned. Now, we just had Xi Jinping meeting with President Biden over the weekend, and the message through Biden from Xi to President-elect Trump is that we will strike back. Are you worried about the potential here for a much hotter trade war than we saw in the first Trump administration?
I mean, I am super concerned and alarmed, and I think all Americans need to be much more informed. And I know Bloomberg does a really good job of it, but it's not common knowledge. It's certainly not Wall Street is pushing out there, and that is the BRICS bloc, And you just saw the BRICS symposium in October in Russia because obviously Putin is the charge of the BRICS bloc this year. And they were talking about specifically, Doug, Project M Bridge, which was a Bank of International Settlements project with 5 central banks, including Saudi Arabia and Hong Kong. And it was to exchange bilaterally in cryptocurrency. And it was basically an alternative being developed to SWIFT. Well, when Putin came out and said at that BRICS symposium that this is a payment platform that we could use to bidirectionally trade amongst our partners in the BRICS bloc, the BIS came out and said, we are going to exit that project and turn that over to China. So that is alarming because this is something that is quite far along in development and could be leveraged pretty quickly to bidirectionally trade using cryptocurrency.
So de-dollarization is obviously a part of that story. Is that a concern to you?
Well, I think that we all kind of say it's going to take years, but the truth is, once you understand that they're going to be able to do this on the blockchain, and therefore they do not need a reserve currency. See, that's the mental shift that no one's understanding. We're all saying it will take years and decades to really and truly fundamentally change a reserve currency. The fact is, if you're dealing bidirectionally on the blockchain, you don't need a reserve. You simply maybe need, like, let's say we could have a new, I'm just going to hypothetically say we could have a new BRICS central bank, and every member country could have a deposit of gold at that central bank. And on every quarter time period or monthly time period, you settle up and you say, hey, you have a net deficit or a net trade surplus. And so we're going to pay you gold or you're going to pay us gold. And there's no reserve because of the fact that we're bidirectionally trading in cryptos.
We'll have more with Rebecca Walser of Walser Wealth Management coming up. I'm Doug Prisner, and this is Bloomberg.
Join Capital Group CEO Mike Gitlin on the Capital Ideas Podcast. It's your look inside one of the world's most experienced active investment managers. Invest 30 minutes in an episode today. Subscribe wherever you get your podcasts. Capital Client Group, Inc.
Hi, I'm Ron Kraszewski, Chairman and CEO of Stifel. Financial advisors, if you're not growing your practice, you're losing market share. Stifel is a growing entrepreneurial, advisor-centric firm built for successful advisors like you. Imagine having the resources of the largest wirehouses and the support of the boutique shops, but none of the bureaucracy to get in the way of you serving your clients. At Stifel, it's your business, your book, your clients. I always tell the advisors we're recruiting, I want you to come to Stifel and double or triple your business. Most of them laugh and shake their heads, but I'm serious. Don't take it from me. Take it from Stifel's #1 finish in J.D. Power's 2023 U.S. Financial Advisor Satisfaction Study. So there's a reason why 148 financial advisors joined Stifel last year. Come join us and find out why Stifel is the firm where success meets success. Visit www.choosestifel.com.
Stifel Nicholas and Company Incorporated, member SIPC and NYSE.
Welcome back to the Bloomberg Daybreak Asia podcast. I'm Doug Prisner. We're speaking with Rebecca Walser, president of Walser Wealth Management. She joins us here in our studios in New York. So we're talking about a world that's becoming more polarized, a lot more protectionistic. How do you translate that into an investment strategy?
Well, it's really difficult because until we really see what happens as Trump's administration takes, is going into bear, we're just not going to know how the markets are going to react. We don't know if this global drop off in demand for oil is going to materialize before his, inauguration in January. So right now, we're sort of just like wait and see, like what's happening. Long-term holds, Doug, always with the AI space. You could definitely, be an NVIDIA, but you have to understand that those things are the frontier, which means they will regress back, they will retrench back, and people should understand that. And then they'll move forward again and retrench and move forward. That's what happened in the dot-com bust. That's what happens all the time when we have a new frontier of technology. So I think that long-term, there's still a great upside runway and trajectory for AI, but the other traditional, plays that we might make, utilities, consumer staples, those kinds of things in a pullback, it's kind of just maintaining inflation right now, if anything else.
What are you assuming for 2025? Economic growth is going to do what? Tax cuts? What are we going to see?
I mean, I think that Trump will, especially if he has both houses of Congress, which it looks like he will try to extend and work through, because his original Tax Jobs Cut Act of 2017 expires at the end of 2025. So that's something that they're going to need to actually go through legislation this year with both houses. So we'll see tax policy, but I'm much more concerned in 2025 at the direction of the global demand. If we see global demand coming down, Trump is going to have a hard time in this very first year of his new term. If we see that he can come in there, that demand is not so tepid globally, and that he really can do new tax policy and he can start, drill baby drill and get the leases and things going again, then I think we could start to see some robust spreading out of the upside growth that we've really just seen relegated to AI in 2024.
What about some of the trades that have been put on during the Biden administration? Green energy, sustainable energy. I mean, do you want to exit those in a big way right now?
I thought it was really interesting, Elon Musk saying that he thinks all government subsidies should be eliminated, including the $7,500 per electric vehicle purchase that's in the American Infrastructure Reduction Act. That was the largest green bill that we've ever passed. And Trump has already said he wants to cut the $7,500 EV credit, tax credit, or tax rebate. So that is definitely going to have an impact on the uptick of electrical vehicles. We've naturally seen, Doug, a drop off in electrical vehicle demand, just as we've seen a drop off in automobile demand. It's because people are feeling the pinch in their pocketbook. They're really struggling with the inflation prices. The problem with EVs is that you're going to have to replace your battery at some point a couple of years down the road. For example, I just ran my Tesla by accident through a puddle after the hurricane. It wasn't even to me that big of a puddle. It was certainly a puddle my car could make it through, but that puddle got the water to reach my battery, and my battery within 10 days had it's corrupted failure. It was like a scary message, like you cannot drive this car, take it immediately, get it towed. And I have to replace the battery, $17,000. So I think that people are starting to realize, okay, it's not just the initial price tag that's also higher, it's also the battery life. I have to replace the battery in like 3-4 years. And these batteries, if they get wet, like in a state like Florida has salt water from storms, it would be corroded. It's over, it's done.
We were talking about tariffs earlier, and I think the thinking behind this in a perfect world is that you're going to get some reshoring of American manufacturing.
Yeah.
Is that a trade that you're interested in playing?
Well, it's a little late, right, Doug? I mean, China is the manufacturer to the world, and certainly they're our number one trading partner, clearly by far and away. And I'm not suggesting that that's where we want to stay and that we don't want policies to repatriate manufacturing base here in the United States. But the problem with the United States is that our laws, our consumer protection laws, our labor laws, all of these things make building things here way more expensive than they are over in Asia. Now, they're not as more expensive as they used to be because China's costs have also gone up as they've industrialized, but still not anywhere near the price of American manufacturing costs based on our laws. So if we get some kind of tort reform, we need some more reforms over here to be competitive and viable to compete with Asia, to compete with Vietnam. We've got to do that. And the problem is Americans aren't for that. They want the jobs, they want the manufacturing base, but they also want to keep, this administrative state that we've kind of created. Mm-hmm. And that's also a problem.
One of the things, obviously, that the Biden administration put on, export controls when it comes to specific technologies, largely targeted at China.
Yep.
Is that a policy that you think the Trump administration will build on, something that the Biden administration started and that the Trump administration could extend?
Yeah, absolutely. I think that President Trump called China out consistently, methodically, and all the time when he was president before, and specifically talking about their ability to get companies over there and then backdoor and get all of our trade secret information. And, there's a lot of multinational U.S. corporations that have obviously Chinese, divisions. And there's a lot of technology transfer that we're just not keeping because of that sieve of information that goes through the way China runs their economy. It's a communist, quasi-capitalist design that we've never seen before in the history of time. And that is allowing them access to information that the government itself otherwise would never have. So I definitely think that Trump would even be more hawkish on China than even Biden.
We had a report on the Bloomberg terminal talking about the fact that maybe some of these policies from the Biden administration have really accelerated a lot of tech development in China. Now, this is coming at an interesting time for the Chinese economy. We know things there are very sluggish.
Yeah.
We just had the rollout of a lot of stimulus.
I had to, yeah.
How would you assess the Chinese economy right now? Is it still kind of trapped in a deflationary period right now that it may take years to emerge from? Or are things beginning to turn? Do you see a bottom beginning to happen right now?
Well, we just got their consumption was the largest it had been in 8 months because of the stimulus that they just, well, we would expect that, right? Though, Doug, if you put a lot of trillions of dollars of stimulus, you're going to get, a higher consumption for the first time in 8 months. So we saw it impacting, but really the way China did this stimulus was very unique. They actually went to the banks and said, hey, banks, we're going to give you money. We want you to go out and buy more real estate. Well, the banks are really nervous about buying this real estate because there is a real estate collapse. And, I know that it's been mentioned, but the way Chinese buy real estate, the Chinese citizens, is they actually have to pay the mortgage before the property's even done. So now you've got people that are agreeing to buy property, pay a mortgage, and yet not even actually have the property. We don't have that in this country. So that is a problem. And then you've got the bank saying, yeah, I think it's great, China, you're giving us money, but we really, CCP, we don't really want to buy more property until we see that the property collapse has been stymied. So I don't think that this stimulus is going to do what they think it's going to do. And so when you see the weakness in their financial sector and their banking sector, and then you see the fact that you've got now a hawkish president coming in who's not afraid to call them out, who's not afraid to say, hey, we'll put a 200% tariff on your EVs so you can't import them, you're going to have more problems in China. So, but do not think that the United States is just going to be able to slap them off and they're going to have to just adjust to us, because this is what I'm saying, Doug. With this BRICS bloc, with this Enbridge now under the authority of the Chinese, they have so many nations that want to bidirectionally trade. India, China, Russia. Those three alone, the population of those three is over 2 billion people. I mean, almost 3 billion people. That is 3 billion of 8 billion people that live here. So I think that this is a massive collective that is forming before our eyes, and we need to understand the power economically that they're going to be able to wield when they become operational.
So before I let you go, if you could share with me some of the conversations that you're having with clients right now, what are they most concerned about?
I think that they are most concerned about Trump, and is he going to be able to get the tax, the tax scheme that he passed in 2017 reestablished, because, that is a really big issue with the estate planning. And just as a tangent really side for a second, right now we have a massive, over $12 million per person that you can pass through death. And that is set to revert back to 2010 levels. So, somewhere in the $5 million range. So that's $7 million plus that each person's losing. So, there's a lot of tax that has to come. Obviously, I'm much more concerned about the global economy. Trump is going to be good as far as an engine driver of growth, but that still will only be able to be as successful as the world is.
Do you expect capital markets to follow in lockstep, or is there going to be some pushback here when it comes to certain policy? We were talking a moment ago about the inflationary policy that the bond market seems to be sensing right now. Are there other things that corporate America is going to kind of reject?
Well, I think that what we're really concerned about is potentially a debt spiral coming to be to fruition, which is the worst case scenario for us. And it wouldn't matter who was in office when you are, accumulating $1 trillion in deficit every 100 days. Our interest expense is now our third largest expense behind Social Security, Medicare, interest. So we really have a third rail here that if we do not get a plan of action together on how we're going to deal with it, this is why the bond market is pricing in so much risk. And Powell coming out and kind of saying, hey, we don't know if we're going to see the data. We don't know if we need another 25 basis point cut in December at the December FOMC. He's saying that because his November 25 bips has already been reassumed by the market. In other words, the market is back up on the 10-year to where it was prior to his cut. And that is a problem for him because when the market is starting to price in risk and taking it away from the Fed is becoming irrelevant. That is really when we're starting to get into potentially a situation where the market's going to say, we don't care what you do, Powell. This is the risk of the bond yields.
Tough times ahead if that comes to pass.
Exactly.
Most definitely. Rebecca, thank you so much. Rebecca Walser, president of Walser Wealth Management, joining us here on the Daybreak Asia podcast.